Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Intel.
If you find our talks useful, please consider subscribe, like, and comment underneath. And stick around because today we are looking at a legacy tech giant that was basically written off by Wall Street, only to suddenly surge roughly 600%.
Yeah, it is honestly one of the wildest turnarounds we've seen in a long time. But before we get into the exact catalysts driving that surge, here is a useful chart tool for you.
Right, VIP Algos. If you want help reading trading charts more clearly, you can check out VIP Algos through the link below in the description.
Exactly. It's a TradingView indicator suite. It shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and, take profit and stop loss planning areas. It works across markets like stocks, Forex, crypto, gold, futures, all of that.
But just remember, VIP Algos is an educational chart analysis tool only. It is not financial advice, and it does not place trades for you.
Right, and it does not guarantee profits. Trading involves risk, so always manage your risk and do your own research. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Okay, so let's unpack exactly why Intel is dominating the market conversation right now. I mean, we are looking at a company that was recently trading at a 52-week low of $18.97.
Yeah, and it's now surging near $122.20 in pre-market action. That kind of price action forces the entire industry to just stop and recalibrate.
It really does. For the longest time, the narrative around them was just pure decline. People saw them as a dinosaur losing ground to sleeker competitors.
Right. But the immediate trigger for this explosion completely flips that narrative on its head. Their 18A-P chip manufacturing process just hit a massive early production milestone,
which is the catalyst signaling a potential multi-year breakout. Yeah. So our core mission for our analysis today is to answer a crucial question. Has this company truly resurrected itself as a modern AI powerhouse, or is this just a temporary bump?
That is the defining question, right?
Yeah.
Because hitting a production milestone is one thing, but sustaining a newly minted artificial intelligence empire is entirely different.
All right, let's move into the wealth building context.
So to understand the sheer scale of the capital flowing into this stock, you have to view this as a structural turnaround play grounded in a massive geopolitical hedge.
Because for decades, the entire global tech industry, especially the U.S., has relied heavily on Taiwan's TSMC for advanced semiconductor manufacturing.
Exactly. And advanced semiconductors are basically the new oil. If anything disrupts that single highly concentrated supply chain in Taiwan, the entire modern economy basically grinds to a halt.
Yeah, everything from your smartphone to your car to cloud server farms to military tech, it all depends on those chips.
And the U.S. government has drawn a definitive line in the sand regarding that vulnerability. That level of reliance on an offshore entity is now viewed as an unacceptable national security risk.
So they are aggressively positioning their fabrication plants in Arizona and Oregon to build the irreplaceable onshore American alternative.
Exactly. The government backing creates a heavy structural floor under the company, which prevents those worst-case bankruptcy scenarios.
But wait, let me play devil's advocate here. Is this a genuine long-term growth story driven by actual engineering innovation, or are we just looking at a legacy company being propped up by a massive government mandate to keep them alive?
It's the perfect question. The reality is that the true wealth-building upside isn't coming from government handouts. The real opportunity lies in a massive valuation reset combined with the multi-year wave of agentic AI.
Right, so the geopolitical mandate forces the door open. But their ability to actually manufacture the chips that power the next decade of AI dictates the fundamental growth.
Now let's look at the fundamentals.
Let's see if the balance sheet actually backs up that turnaround story, because making promises is free, but building fabs is incredibly expensive.
It takes tens of billions of dollars. But look at their first quarter 2026 revenue, which hit $13.6 billion. That is a 7% year-over-year increase.
And crucially, it marks their 6th consecutive earnings beat. But the headline revenue isn't even the most important part, right?
Right. It's the composition of that revenue. AI-driven businesses now make up 60% of their total revenue.
Wait, 60%? For years, they were known mostly as the processor sticker on your consumer laptop. That is a massive pivot.
It really is. Their data center and AI segment surged 22% to $5.1 billion. Meanwhile, the foundry segment climbed 16% to $5.4 billion.
What fascinates me most about their current position is how structurally de-risked the balance sheet has become. The U.S. government converted $8.9 billion in grants into a 9.9% permanent equity stake at $20.47 a share.
Which is a massive distinction. We're not talking about a loan that has to be paid back. We are talking about permanent equity.
Hmm.
The U.S. government is literally a shareholder now.
And it isn't just the government. Nvidia dropped a massive $5 billion equity investment at $23.28 a share to co-develop x86 RTX systems on a chip.
Let's translate what that means for you listening. Nvidia dominates the GPU side, which handles AI processing. By co-developing a system on a chip, they are physically integrating both architectures onto a single piece of silicon.
So Nvidia's $5 billion investment is the ultimate validation. It proves that this On4 Foundries technology is vital to the future of AI hardware.
Right, and that leads perfectly into their competitive moat, specifically regarding their new 18A-P manufacturing node. It is design rule compatible.
Which sounds deeply technical, but let's use a software analogy. Moving chip manufacturing from Taiwan to the US is usually like deciding to rewrite a massive software program in a completely different programming language.
Yet it's agonizing, incredibly expensive, takes years, and introduces thousands of bugs. It's an operational nightmare.
But design rule compatible means the customer doesn't have to rewrite the code. They can take the blueprints they were already using, bring them to the US fabs, and essentially just hit compile.
It makes the transition seamless. However, to maintain a balanced view, we have to look at the profitability metrics. On paper, they posted an incredibly ugly GAAP operating loss of $3.1 billion.
Whenever you see a $3 billion loss, the immediate reaction is panic. But it's similar to a massive real estate investment, right? Like buying a multi-billion-dollar factory.
Exactly. The upfront mortgage, or the depreciation from the $108 billion in capital expenditures they've spent, makes the bank account look terrible on paper every month.
Right, that loss is the accounting mortgage. But if you strip away that depreciation and look at the underlying cash flow, their non-GAAP operating margin actually hit 12.3%.
And their adjusted earnings per share absolutely crushed Wall Street estimates, coming in at 29 cents when the market was only expecting a single penny.
That brings us to the catalyst timeline.
So what will physically move the stock price over the next 3 to 6 months? We are looking toward late July and August for the second quarter 2026 earnings.
Because earnings are the ultimate reality check. You can have all the narratives in the world, but the quarterly report forces you to show your math.
Exactly. But even before that, the 2026 VLSI Symposium is currently underway in Honolulu.
Which sounds like a corporate retreat, but it's actually highly technical, right?
Right. It's where hardcore engineers present peer-reviewed papers. And that is exactly where the 18A-P risk production milestone was just officially confirmed.
So passing the test among the smartest people in the industry, and looking further out, CEO Lip-Bu expects multiple hard foundry customer commitments in the second half of 2026.
On top of that, there is a significant macro-political catalyst. The incoming administration is aggressively recruiting Wall Street dealmakers to bolster national security supply chains.
Right, and impartially speaking, strictly looking at market mechanics, this heavily benefits an onshore manufacturing mandate. It signals a serious federal push to prioritize domestic production.
Yeah, when you have federal policy, heavy capital, and Wall Street expertise aligning, it naturally accelerates these massive infrastructure projects.
I hear that, but let me push back. The stock went from $18 to over $120. Are these symposium announcements and macro events already priced in?
It's the most vital question. A significant portion of the survival risk being removed is absolutely priced in. However, what the market hasn't fully priced in is the long-term margin expansion.
So if those late 2026 customer commitments actually materialize, the revenue ceiling is much higher.
Now let's pivot to the chart.
All right, let's translate the fundamental momentum into actual price structure. What's the volume telling us?
The stock just broke out above the $110.63 EMA 50 on massive volume. We saw a recent spike of nearly 151.5 million shares traded.
And retail traders buying 10 shares on their phones don't generate that kind of volume. That requires serious institutional money actively accumulating massive positions.
Exactly. And despite that huge surge, the chart isn't overheated yet. The 14-day RSI is only sitting in the mid-50s.
So it has significant room to run to the upside before hitting overbought territory. What are the key levels to watch?
Analysts are watching the $115 level. A decisive break above that is the trigger expected to pull in algorithmic buyers. with near-term upside targets at $123.80 and $134.
But we always have to remind you that technical charts show probabilities, not guarantees. Support levels can break. This is exactly where tools like VIP Algos can help you visualize these breakout levels clearly.
Right, it stops you from flying blind.
So what does market sentiment look like?
The prevailing mood is highly bullish. Bank of America recently upgraded the stock from underperform straight to buy, boosting the target to $135.
Jumping straight from underperform to buy is a massive revision. What specific data points justify that leap?
They forecast that the server processor market will hit nearly $170 billion by 2030, driven almost entirely by the rise of agentic AI.
Let's define agentic AI. It's not just a chatbot. It acts as an autonomous agent that can execute complex tasks without human intervention, which requires an exponential leap in computing power.
Exactly. And to capture that market, you need concrete wins. Google has placed an enormous order for over 3 million TPUs for 2028.
Which are Google's custom-designed silicon for machine learning.
Yep. And alongside Google, Microsoft is formally reserving manufacturing capacity for this new 18A process. When hyperscalers validate your roadmap with their wallets, it shifts everything.
We also have the rumor mill running hot. Speculation that Apple is discussing shifting some massive processor production to these U.S. fabs, and a Hitachi partnership for physical AI in robotics.
The robotics angle is fascinating because it expands their footprint far beyond traditional data centers.
But I have to be the voice of reason. The institutional validation from Google and Microsoft is phenomenal, but you have to separate fact from fiction regarding Apple rumors. Speculative hype can be a trap for retail investors.
Now, let's talk about the risks.
Because a 9.0 bullish thesis can still shatter if execution fails.
Right. The primary threat is yield and execution risk. Right now, the yields on their 18A process are stuck between 55% and 75%.
Wait, so a 55% yield means nearly half of the chips on every silicon wafer are defective and go straight into the trash.
Exactly. The raw material cost is the same, but you only have half the product to sell. That absolutely destroys profit margins. They must scale those yields up efficiently.
And we also have that depreciation drag from the $108 billion in CapEx. It's a massive ongoing headwind.
It will weigh heavily on the reported earnings for years.
And the ultimate risk, if TSMC innovates faster while Intel struggles with yields, hyperscalers like Microsoft could easily walk away and the turnaround narrative collapses overnight.
Very true. But the yield risk is partially mitigated. The 18A-P node shows 9% higher performance and 18% lower power, proving the engineering is moving in the right direction.
So with everything on the table, what's the final verdict?
Synthesizing everything, the final bullish score sits at a very strong 9.0.
That is serious conviction for a company that was struggling so heavily just a year ago.
It is. The rating suggests a multi-year timeline, roughly 12 to 24 months, to capture the 18A ramp. They've essentially transformed into a de-risked, U.S.-backed premier alternative to TSMC.
Just remember, this analysis is not financial advice. You must manage your own risk. But it leaves you pondering a larger question. If agentic AI expands the market to $170 billion by 2030, will owning onshore fabs become the most valuable geopolitical real estate on the planet?
It's a massive question.
Before we go, if you want a cleaner way to read trading charts, check out VIP Algos through the link below in the description. It's a TradingView indicator suite with visual buy and sell alerts, trend tools, and TPSL planning areas. It is an educational tool only, not financial advice, does not guarantee results, and trading involves risk. Also, it is an affiliate link at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wolf with Joshua episode.